President Trump says imposing tariffs will make steel companies and farmers happy. But look at what happened to steel prices since the president's first imposed metals tariffs in March of last year. Prices rose, hitting a high of $920 per ton. Companies reopened, shuttered mills and started hiring workers. But the price spike was actually just a blip. Increased production, along with a drop in demand, caused prices to fall back. That hurt companies like U.S. Steel, which closed some of its furnaces and laid off staff. In October, Moody's downgraded its outlook for the entire steel sector to negative, saying the situation is unlikely to improve anytime soon. Even still, Trump says raising steel tariffs could help turn the tide.
Well, Brazil has really discounted. If you take a look at what's happened with their currency, they've devalued their currency very substantially by 10%. Argentina also. And I gave them a big break on tariffs, but now I'm taking that break off because it's very unfair to our manufacturers and very unfair to our farmers. Our steel companies will be very happy, and our farmers will be very happy.
Joining me now is Mohamed ElErian. He's the Chief Economic Advisor at Allianz. So you heard the president just talking there. I'm actually not sure if you heard him, but he was saying that steel companies in this country would be very happy, that farmers would be very happy. But just when you look at the president's trade strategy overall, how much has it actually benefited U.S. manufacturing?
So the weaponization of tariffs has had the three impacts if you go from low to higher. The lowest impact is in changing other people's currency behavior, because, as was just said, these have been market forces. The one exception to that is China, but that is very specific. It has had more impact in starting to get some concessions for the U.S. And the most impact is what you don't see, which are companies reconsidering their supply chain. Some of it is going to other countries, some of it is coming back to the U.S. But the big test is going to be what happens when we look back in 2 years' time. Will this phase of trade tensions be viewed as part of a journey to a free but fairer trade regime, or will it end up being a destination? And that's going to be the big question mark.
But you bring up a very important point, and that is, you know, when the president raises tariffs, yes, it might change behavior. Yes, people might reconsider China, but that doesn't automatically mean they're going to be moving to the United States. There are other countries in Southeast Asia that are benefiting enormously from the US-China trade war. What are some of those countries?
So we saw that in round one, Vietnam being a perfect example. But it turns out that Vietnam doesn't have the infrastructure to absorb all the demand for outsourcing that's going that way. So we've seen Indonesia benefit as well. We've seen the Philippines benefit as well. But ultimately, these countries are going to hit capacity constraints. And that's why you see businesses also bringing back some of their operations back to the US. But I think that we are going to see a significant diversification of outsourcing away from China. What you're going to hear more and more is in China for China. So those who establish big presence in China is going to be in order to supply the Chinese market.
I see. And when you look at the manufacturing data we got today, for example, 48.1%, what does that tell you about the effectiveness of Donald Trump's trade policies?
Yeah, you see it all over the world. Same story for Europe. What it tells you is that the globally oriented companies, and manufacturing has a good component of globally oriented companies, are at risk. So you're seeing two different economies, whether it's here or in Europe. It's even more acute in Europe. The domestic economy that's doing fine, the manufacturing economy and business investment doing less well. And the big question is, who will contaminate who? Will the weak manufacturing contaminate the domestic side, or will the domestic side lift up the manufacturing side? And that's going to play out over the next few months.
It's so interesting because, you know, when the president talks about or tries to promise that steel jobs are going to come back in this country, there's going to be revival in manufacturing. I mean, is there a better strategy that the president should be employing to bring back those jobs? Is there a better way at all? Or are those jobs just gone for good?
So the best way is on two things. One is vis-a-vis the rest of the world, is to try and promote economic growth there. The problem is not the US. The problem is that the rest of the world has slowed down significantly, and we are importing to some extent that slowness. But domestically, we also have to focus much more on retraining workers, retooling workers, and infrastructure. Unless we increase our own productivity, this weaponization of tariffs is simply going to be a lose-lose game for everybody. And that's why ultimately it's about what countries do domestically and whether you get to a fairer but still free trade system.
And actually, the president quoted you today in a tweet. Let's pull it up for our audience. Let's see. I don't know if I can read this without my glasses. The United States has... If you could help me, Mohamed, just read this without my glasses.
I was talking about the extent to which the U.S. markets have outperformed other markets. So I noted, he notes in that tweet, quote, the U.S. has outperformed the rest of the world in an eye-popping fashion. I don't think we've seen numbers like that. Mohamed ElErian, Allianz Chief Economic Advisor. And then he goes on to say, but despite this, there's tremendous potential for growth, far greater than most have understood.
Okay, so when you see that, I mean, what would you say was still the major headwinds in the U.S. economy, though?
So here I was talking about the markets. It is eye-popping to see how much the U.S. has outperformed other countries. Had you invested $1 in the US and $1 in emerging markets 5 years ago, the difference is 150%. We have never seen that sort of difference before. It speaks to the fact that emerging markets are going through a difficult period and are more vulnerable to trade tensions. The reason why I said that this morning is that a lot of people are telling investors, fade the US and take your money out and put it elsewhere. And I'm saying it's too early for that.
So when is the right timing to do that, then?
When you see the following three things. One is pro-growth policies in the rest of the world. We haven't seen that. Two, a reduction in trade tension. We haven't seen that. And three is something very technical, which we see starting to see flows go to the developing world. The time is going to come because you can't have these massive divergences. It's just not now.
Okay. So it's all about timing. Can I just say thank you so much for helping me? I literally am as blind as a bat without my glasses, so that was very embarrassing, but thank you so much.
I had to squint as well. I could hardly see it too. So.
Well, thank you.